there's a risk in trying to get out too early as much as the risk of staying in. It resembles, an arms race. The problem is that in an arms race, everyone cannot win an arms race. And in fact, in some cases, no one wins an arms race. There's basically been the demand to move assets or kind of exposure out of the U.S. and the U.S. dollar in particular will probably go on for a while longer, at least as long as Trump is there and causing chaos. People outside the U.S. are trying to look for alternatives to the U.S. dollar. There aren't a lot of good alternatives, so that's why gold has benefited.
Sam Burns returns to the show. He is a chief market strategist at Mill Street Research. Sam was on the show a couple months ago, back in August. Back then, he was already warning that market momentum and economic growth momentum may stall. Well, it's been a few months since then, and it looks like it's stalling now. So we'll find out what's happening right now and where are investors rotating their capital to. Welcome back to the show, Sam. Good to see you again.
Thanks, David. Good to see you again. You
had argued a couple months ago that momentum was fading. The U.S. economy entered 2025 with strong momentum, but you believe that it was weakening just late summer. The primary reason was fiscal policy has turned from a tailwind to a headwind. Under the current administration, policy shift is growth negative, and the equity model whipsaw. Your model made its fastest move from bearish to bullish in 33 years, and historically a rare V-shaped transition in risk appetite drove the change, not better fundamentals. And now we're kind of seeing that risk appetite reverse a little bit. Bitcoin is below $87,000, so we're at a year-to-date loss on Bitcoin. The Nasdaq today is down almost 1%. This is after NVIDIA beat earnings and made a strong announcement just last night, and that wasn't enough to sustain the entire market. So this sell-off that has been going on for quite some time now, what is this a reflection of? And generally speaking, what is your position on the economy today relative to a few months ago when I had you back on?
I think you're right that the key to equity markets has been risk appetite. Really, certainly since April, it's basically been a massive risk-on move from April to sort of mid-October, which is when a lot of the really speculative, risky assets peaked and have now some of them have pulled back quite a bit, including Bitcoin. But a lot of the, really speculative equities have also pulled back quite a bit. Whereas the overall market, is down maybe 3 or 4%, I think, from the peak for the S&P 500 and some of the major indices. So I think what's been going on has been a big rotation away from the really speculative, companies that have little or no earnings and crypto assets and things like that. Back in favor of companies that do have earnings and a little bit broader participation within the equity market. I think that also represents the fact that the economy is kind of undergoing this kind of K-shaped, pattern where the higher end, the higher income households and larger companies are doing okay or doing well, whereas the kind of middle and lower income households and smaller companies are struggling primarily due to policy. So I think that's what we're seeing in the markets as well as in the economy right now.
Like I mentioned in the introduction, people are rotating capital out of stocks. Where are they going? Do we know?
I think a lot of the money is staying in equities. It's rotating within equities. Some of it has gone into fixed income probably, and some of it is leaving the U.S. market and probably going into ex-U.S. markets. So a lot of overseas equity markets have been actually outperforming the U.S. recently, and the dollar has been sort of weak earlier in the year and stable a bit lately. So I think there people are repositioning between U.S. assets and non-U.S. assets as well as within equities themselves.
What are the main forces or macro variables you're watching that could drive markets into 2026? In other words, the most important things for the markets into the end of the year, into the new year.
I think the big thing for the major indices is going to be the earnings, particularly for the tech sector, the AI stocks, a lot of those big names that are really driving both the market in terms of price, but also the earnings. Earnings reports for Q3 were mostly all very good, better than expected. Earnings estimates are still rising for the U.S. So as long as that's the case, I think there's some sort of earnings tailwind, but a lot of that depends on the kind of the big companies doing well or continuing to do well. I think the economy is going to be a lot more mixed. We're starting to see the unemployment rate creep up, even though immigration and sort of labor supply has kind of declined. So I think we're going to have more of a mixed picture for the overall economy. I think the Fed is kind of a bit stuck in terms of its ability to respond policy-wise as aggressively as they might otherwise. I think that inflation is telling them one thing and the labor market is telling them something else. So we're going to get, maybe one or two more cuts over the next 6 months, but not a lot. So I think that will kind of limit what would normally be otherwise be happening in terms of stimulus.
So let's talk about some current data here, starting with the labor market. So we have here the number receiving unemployment benefits highest since August, according to the Labor Department. As you know, the government's been in shutdown, so we haven't really been up to date with government data. But from what we know, the labor market has continued to weaken. More than 1.9 million Americans filed claims for unemployment benefits in mid-October, the highest mark since early August. For the week ending October 18th, 1.957 million people filed for unemployment insurance, with 232,000 filing new claims. The data compiled with the department's Employment and Training Administration is seasonally adjusted. The number of Americans filing for unemployment marked an increase of 10,000 people relative to the week prior, ending in September 20th, rather, and the highest number since 1.961 million in August 9th. Can you just respond to that data and other, I guess, labor market data you're looking at, and give us a picture of how well the jobs market is performing right now?
Yeah, you're right. And certainly we're flying a little bit blind just because the government shutdown has prevented some of the normal economic data from being collected or released. Just today we got data for September, which of course is well out of date for the monthly employment data. The weekly unemployment claims data that you were mentioning there have deteriorated somewhat, I think, in the last month or so. They kind of shifted kind of back in around, I think, April, May to somewhat higher readings and have been sort of stable at that general range recently. So the labor market isn't terrible, but it's not great. I think it shows that hiring is probably lower, but there's not a lot of widespread layoffs yet. So I think we're kind of in this sort of stasis where there are not as many people hiring, but also not as many people available for work. The labor supply has also gone down. So you're kind of in this mixed scenario, but the unemployment rate that they just released this morning was up another step from last month, about 4.4%. So I think there's basically been a gradual, kind of slow deterioration in the labor market after very strong readings in 22, 23, 24. I think we're starting to gradually deteriorate, in part because demand is weakening and in part because of the immigration and labor supply constraints.
At the same time, though, we have some maybe potentially conflicting reports. So the jobs report that came out recently defied expectations. Employers hired far more workers than expected in September, defying a sharp slowdown over the summer that appeared to cool off the labor market. So the U.S. added 119,000 jobs in September. According to data from the U.S. Bureau of Labor Statistics, that figure marks an acceleration from the previous month. I know September was a while ago, but I guess that's the latest data we have right now. Correct me if I'm wrong. And like you mentioned, the unemployment rate did tick up to 4.4%. So on the one hand, there was more hiring at some point in September or August. But on the other hand, the unemployment rate ticked up and the initial or continuing claims have been going up. So yeah, this how do you parse through this supposed or this juxtaposition here, this dichotomy?
Yeah, and you're right. It is sort of confusing and gives different messages. I think the non-farm payrolls, is a noisy data set, and particularly lately. One of the things people have noticed is that prior months have been revised lower for that series a few times recently, including this latest reading. The numbers for the August for the prior month were revised down. So I think what we're getting is, again, fewer people being hired, but also not very many people being fired. And so that means it's a less dynamic labor market, but not a terrible one so far. I think the fact that labor supply has declined, which is harder to measure, that means that the rise in the unemployment rate is less than what it would have been otherwise. The number of new jobs over the last, say, 3 to 6 months has been quite low, and would normally be much more of a recession warning. But now, because there just aren't as many people available to be hired, it's less of a sort of dramatic concern. And I think that's one of the reasons why the Fed has been very sort of back and forth and hesitant, because they're not quite sure how weak the labor market is either, because some of the numbers, in absolute terms are weak, but in relative terms, they're not so much if you account for labor supply. I think that's been the problem is the immigration change in labor supply has been so stark and so kind of unusual relative to the last few years or most periods in history that it's hard to figure out how to read that in the data because we just normally don't see that level of a shift in immigration and kind of new labor supply coming in. Normally, it's been more stable than that. So a lot of economists are really struggling with how to adjust for that. What's the right number to expect for non-farm payrolls or claims or things like that, given that we're in a very different sort of scenario for labor supply right now.
Okay. Are you concerned about more layoffs, though, into the new year and potentially into Q1 2026?
I think there's definitely a risk of that. I think so far, aggregate spending, by consumers and by businesses has held up. So I think to the extent that there's still spending going on, there will be still sufficient, labor demand that people won't want to fire their workers too quickly. And I think the impact of kind of AI replacing workers is sort of maybe exaggerated in some cases, in the sense that I don't think it will be visible in the aggregate U.S. economic data that quickly. I think it might be a gradual thing that happens over time, but not, kind of all at once. So it's more a matter if people have money to spend and they're still spending it, then there'll be there won't be an incentive for companies to be doing a lot of layoffs. They may just limit how much new hiring they do as they're kind of figure out what's going on with policy and tariffs and immigration and all the rest of it. I think a lot of companies have been kind of putting projects on pause and outside of AI and tech and trying to figure out what's going to happen next year.
Well, projects can't be put on pause indefinitely. So at a certain point, companies have to say, all right, we have to bite the bullet and just wade through this uncertainty. Is that moment, close, or is there going to be any such moment, you think?
I think the data so far has shown that you basically have a lot of investment, corporate investment has been very strong in tech and slowing down basically everywhere else. Most non-tech parts of the economy are not seeing a lot of new investment. People are not building, new factories and buildings and things like that outside of data centers and technology. And I think that's in large, part because of the uncertainty about, policy and labor and interest rates and all that kind of thing. I think if we got some more rate cuts by the Fed, I think if spending holds up and some of the policies, like tariffs start to go in reverse, get cut back, that might allow some of these companies to go forward with some of the plans they put on hold if they think that there's going to be some clarity and they won't suddenly get hit next week with a whole bunch of new tariffs or some other weird change in rules and regulations that would derail their plans, particularly anything that has to do with international, global kind of expansion or building factories from companies overseas. A lot of that stuff I think has been put on hold and is waiting for more policy clarity. So, for instance, if the Supreme Court were to rule that some of the Trump tariffs were illegal and they start getting rolled back, that might give some of these companies a little more willingness to step forward and do some business, as long as they don't think something else will come along, to replace them.
What, in your opinion, is maybe the biggest risk facing the economy right now?
I think the biggest risk is still, fiscal policy. I think, the immigration and tariffs and all the kind of related, policies like that, as well as the healthcare policy, which has done a lot of damage to the U.S. healthcare sector. Those are probably the biggest risks. I think if not for that, I think the economy would be doing better, and you wouldn't see the kind of labor market, kind of distress we're starting to see. I think the tech sector and AI and all that is helping, in some ways, but it's not enough to keep the labor market strong. I think it's enough to keep some parts of technology, the stock market and the kind of technology-related investment up. I also think that the overall economy is more sensitive to the stock market and asset prices than it used to be. A lot more people are exposed to markets and in terms of their just wealth and their income and their spending than was the case, in prior years. So if the stock market does go down a lot, I think that'll have more impact on the economy than it would have, say, 5 or 10 years ago.
Are you concerned about credit spreads widening and potentially deterioration in the financial sector?
I actually think the financial sector itself is generally fine. And that's actually one of the sectors that I have been telling clients if they're looking for kind of a contrarian or out of favor sector in equities to look for, the earnings estimates for financials are actually holding up quite well. I don't think credit is a big problem for most of the economy. There are always going to be a few spots where things are riskier or starting to look wobbly. People are worried about some of the AI related, data center debt and things that have been pushed around. But I think overall credit is pretty decent. There's been some deterioration in some of the consumer credit side of things, but overall, I think still, companies and people can pay their bills, and most companies and households are in aggregate not over leveraged. So I'm not as worried about that. It's more, either certain specific sectors or people just worried, about some of the exposure to things that I think has probably been overdone at this point. So I think if the tech sector and AI really crack, that's going to have a ripple effect. But I think overall right now the data look reasonably good for the financial sector and credit in general. I don't think credit spreads in general are going to go up that much for a while now.
All right. Well, let's talk about the Fed now. The Fed has to deal with inflation and unemployment. So let's talk about the inflation side first, and then we can move on to talk about Fed policy, factoring inflation and the jobs market that we just talked about. So inflation right now has been trickling up all year. If you look at trueflation, though, which is private sector data, it's at 2.4%, which utilizes, it's basically, let me just take this indicator here. Another economist was bringing it up earlier to me. Trueflation CPI index utilized modern consumer and spending data sets along with cutting-edge technology to deliver the world's only verifiable daily inflation indexes. So that's lower than the government data, but the government data has been ticking up, and we know that the Fed looks at government data. So give us just a rundown of what has happened with inflation so far in 2025, what has influenced this rise in CPI, and ultimately where you see it from here.
Yeah, no, and it has been confusing, obviously in part because we don't have some of the data for the most current months that we'd like to have, but also because there's been a sort of an underlying shift in that for a long time, the main driver of inflation was the services side of the economy, including housing, but a lot of services in general were where the inflation was, whereas goods prices were coming down rapidly after 2022, and were actually somewhat falling until earlier this year. The shift has been that goods prices have been starting to go up. So washing machines, a lot of appliances and things, particularly things that are imported because of the tariffs and things like that. Whereas the prices for services, including housing, have been slowing down. And then the services is a bigger weight, is a bigger component of the overall CPI and the inflation data that you're seeing. So depending on which particular metrics you're looking at and what weights you put on them, which is the difference maybe between trueflation and the CPI, or the personal consumption expenditure price index that the Fed focuses on, things like health insurance costs or auto insurance, and a lot of those factors that are harder to measure somewhat and may not show up in some of the data like trueflation. Those are what have been holding up inflation, and it's really the fact that goods prices are going up, which is unusual, that I think has got the Fed worried, because they are very directly tied to the tariffs and the disruption in trade that we've seen most of this year. And I think that's what their concern is that there's more to come there, that companies have been absorbing some of the tariff and cost pressures, but they may have starting to run out of their ability to do that, and that they're going to have to start raising prices more as we go over the next few months. And if that happens, that's going to keep that sort of CPI number, higher than it would otherwise be, and is already higher than what the Fed's target is. So it's around 3% or just under, and the Fed would like it to be kind of around 2.5%. So if you're looking at inflation that's above target and maybe going the wrong direction, that's, I think, going to limit them from wanting to do a lot more rate cuts. They've already cut rates twice this year, but it looks like they've been saying they're probably not going to cut again in December at their next meeting. They might cut again early next year if the labor market slows down further. But what you've also seen is other central banks outside the U.S. have continued to cut all year because they're seeing inflation pressure start to ease a bit. And I think that would have been happening in the U.S. except for the tariffs and the other disruptions. And so I think that's the reason the Fed has already basically said we would have cut rates more already except for tariff and policy uncertainty. And so now they're saying, well, labor market's starting to slow down, so that's a reason to cut, even though inflation is still kind of high. And you've got a split in the Fed. And actually, last month's meeting had a very rare scenario where one member of the Fed dissented because they wanted to keep rates up, and another member dissented by wanting to cut rates more. So they've actually dissented in both directions, at the same time, which historically is quite unusual. So I think there's been a lot more dissent within the Federal Reserve Board, the FOMC, about which way to go, particularly now that the composition of the board has changed a bit.
I have to talk about this trending topic that's been on everyone's radar pretty much in the last couple of months. Since we spoke, the issue has exacerbated the issue of whether or not the tech sector is in a bubble. And now, as a lot of people are aware from the propagation of this fact on social media, a lot of AI companies are sending money to each other in what's called circular financing, basically propping up each other's earnings and stock prices, while the rest of the sector at the S&P 500 has potentially lagged behind. And that's more indicative as you look down the value chain into the medium cap stocks and small cap stocks like the Russell 2000 that has continued to lag behind the S&P 500, which again is propped up by a few companies which are propped up by sending the money to each other. So that looks like a bubble to a lot of people. Does it look like a bubble to you?
I think certainly the spending, the Capex and all that kind of thing definitely looks like, kind of has some bubble characteristics for sure. I think there's a lot of extrapolation going on about growth in that tech, AI space. And to me, it resembles, an arms race, where each of these, major companies is trying to be the first one to get the biggest, best AI model and to kind of capture the market in some sense. And I think, the problem is that in an arms race, everyone cannot win an arms race. And in fact, in some cases, no one wins an arms race. And so I think while there may be, some company that kind of, wins, the fact that, right now it's basically NVIDIA is the main winner in the sense that they're the ones selling all the chips to everybody to do all of this. And but Microsoft and Meta and Google and the rest of them are building a lot of data centers, and they all say their customers are demanding more, both AI but also cloud computing and kind of moving technology into data centers and things like that. And if there's more demand than they can handle, if that's true, then it makes sense to build more. The question is whether that's going to be, say, 2-3 years from now, going to have turned out to produce enough and return on investment. If there's going to be enough revenue behind it to justify whatever it is, for $500 billion or $1 trillion of capital expenditure to build all these new data centers and spend all the money on chips, which as chip technology moves quickly, and so they depreciate quickly. In 3 years, what's a high end chip now will not be a high end chip in 3 years. It will have been superseded. And I think that's the risk that you have, is that what you're building will depreciate fast, and that the companies may look back and say, okay, well, we overspent on some of this. Most of them are justifying that by saying if they don't spend now, they'll fall behind. But that's the arms race mentality. And I think that's the risk that people kind of, some companies will win, but everyone cannot win. And the market is acting as though everyone can win.
Well, NVIDIA just released earnings, and I'll just give you some stats. Reported $57 billion revenue versus $54.9 expected. So blowout results temporarily erased fears that the AI bubble was going to pop. So what do you do as an investor when confronted with information like this, that these tech companies are generating a lot of top-line revenue? They are managing growth and earnings well, so they're not losing money for the most part. And some would say that the growth multiples are justified. But on the other hand, they look expensive relative to peers. They look expensive relative to the rest of the market. And there's fears of circular financing propping up this bubble. So what do you do? On the one hand, you got good results. On the other hand, high valuations. But also the Fed is still in an easing cycle. Do you buy stocks in the tech sector right now Just looking at these facts, or do you stay on the sidelines?
Yeah, I mean, in my work with my institutional investment clients, I've been telling them to, stay in equities, generally speaking, and to stay in the tech sector. Now, what I have told them is that you have to be a little bit more discerning and differentiated within the tech kind of space. That for a while, for instance, the technology sector and the communication services sector, which is where companies like Google and Meta live, those two had been kind of moving together. In terms of outperformance and strong earnings estimates and things like that. And more recently, we started to see that the communication services sector has kind of pulled back a bit. It started to lag. The earnings estimates are not quite as strong as they were before. Meta's earnings kind of made analysts a little bit less enthusiastic there, as well as some other companies like Netflix or T-Mobile and things like that. So I think you're starting to see a little bit of more differentiation within some of the tech space. Oracle as well, got a big boost a few months ago and is now starting to kind of lose some of that momentum. Whereas, Google has done very well. Apple's done well lately. Microsoft, Broadcom, some of the other, kind of big names are doing well, and their earnings estimates are still rising. Analysts are still having to raise their forecasts because they've been too conservative. So to me, that says that there is still a good reason fundamentally to stay in, and that, yes, some of these stocks are expensive, but they do have high margins, high ROE, and still have revenue growth. So they're they, at least to some degree, earned their multiples. And so I think there's a risk in trying to get out too early, as much as trying to, as much as the risk of staying in, if these are really where the leadership still is. And I think as long as there's sufficient risk appetite still there to buy companies that do have real earnings that are rising, I think that's going to, argue for staying in some of these areas, at least for a little while longer. Not forever maybe, but I think it may be, you have to wait for signs that things are really starting to shift on the fundamental basis before there's an argument to really get out of them entirely.
Well, let's talk about your outlook for interest rates and markets overall. So Trump jokingly threatened to fire Bessent if he doesn't lower interest rates. It's a joke because Bessent can't lower interest rates. The only thing Scott's blowing it on is the Fed. He said at a Saudi U.S. investment event in Washington, "Rates are too high, Scott, and if you don't get it fixed fast, I'm going to fire your ass, okay?" I don't know. I haven't seen the footage, so I don't know. I don't know what Scott Bessent said in response to that. Probably just chuckled. I don't know. But someone's getting fired if rates aren't lower. I don't know. Can you respond to this and just generally give your outlook here?
Yeah, and this is the problem, of course, that we're all facing, is that this is just wildly out of norms in terms of how presidents behave with regard to the Federal Reserve or even their own Treasury Secretary. Yes, as you said, the Treasury Secretary cannot lower interest rates by himself. The Treasury Secretary does not hire and fire the Federal Reserve Chair. And of course, Trump appointed Jerome Powell as the Fed chair in his first term, which he keeps seeming to forget. And so now Trump did put a new Fed board member on recently, Stephen Moran, once the former Governor Kugler resigned suddenly. And Moran has been pushing aggressively for lower rates during the Fed meeting, the last two Fed meetings that he sat in on. So I think that Trump is having that influence and does now have sort of his lackey on the board. But he's one of 12 members of the Federal Open Market Committee. So so far, he has not been able to kind of force the Fed to lower rates. And Jerome Powell has made clear that he's not in a hurry to lower rates aggressively the way Trump is pushing him to, and that he doesn't agree with the arguments for lowering rates aggressively. And so I think, so far, I think also people around Trump have probably explained to him that if he does suddenly try to fire Jerome Powell, that the markets would take that quite poorly. The stock market would probably go down, and there would be a loss of confidence in whoever he would choose to replace Powell potentially. So I think that's why he's trying to kind of shove the responsibility off onto to Scott Bessent, even though that's not really his role. I think that a lot of this is just babbling and wish casting, and kind of trying to jawbone things the way he wants them to go for his own benefit. I don't think there's a lot of good arguments for lowering rates aggressively. You could lower them another 25 or 50 basis points, and that'd probably be fine. But if inflation is still too high, and the unemployment rate is ticking out, but 4.4% is not historically a high number. And so I think it's hard to argue, particularly if spending is holding up, that we really need aggressive rate cuts at this point. And I think that's why the Fed is doing what it's doing, which is probably, not far from what it should be doing, in my view. So I think this is just more political posturing and evidence that we should not listen to Trump.
Fair enough, but the Fed has to look at data that's in the rear view mirror, data that has already happened. But if you had to work at the Fed and make a forecast based on current data or speculation or trends, how would you, let's say, put it this way? If you had to take a guess as a Fed official as to where consumer spending is headed into the first quarter of 2026, which could impact inflation and which is a product, let's say, of the labor market conditions, what would your forecast on consumer sentiment and consumer strength be, keeping in mind that the University of Michigan just released its sentiment indicator for the prior month, and it was possibly the second lowest, I think, in its history after the early 80s. So consumer sentiment is really, really bad right now.
No, that's right. I think, consumer sentiment has been quite weak. I think a lot of people see the economy as sort of, weakening, and the labor market as well. And I think that's also reflective of the fact that that sort of K-shaped economy we're in, where the well-to-do are doing fine and everybody else is maybe not so much, means that the majority of people are maybe, anywhere from okay to not so good right now. But because a lot of the spending comes from, the kind of higher income people and the larger companies, you don't see it in the data so far. And so I think that's why the Fed is struggling, that the average person or the average company is kind of, maybe okay at best, whereas the aggregate numbers are still generally, looking okay. I think that's a tricky dynamic to manage, because interest rates are a very blunt instrument, and it's hard to decide, how they affect the economy, and they affect it with a lag. So my guess is that we'll probably see that continue going into the first quarter of next year. I think the high end holds up. If we started to get some relief on policy, I think that would improve things. If we don't, I think things will continue to struggle. I think the Fed will have to cut rates maybe once or twice more. But as long as tariffs are pushing inflation up, I think they're going to have a hard time arguing that they should lower rates with inflation, around 3%, above target. And a lot of people seeing prices at the grocery store going up, that's not really a reason to cut rates. So I think fiscal policy is much more important than monetary policy in terms of its effect on the economy. And the fact that we are still running, a decent sized federal deficit. So there is still kind of money being printed, essentially, coming into the economy. It may not be allocated as well, but it is still there. And so I think that's going to keep, a certain level of spending going, even if, policy is kind of throwing sand into the gears of the labor market and the international trade.
Okay, so it's almost the end of the year. Let's finish off on your outlook for markets. I have here a chart showing some of the major asset classes that we regularly talk about on the show, starting from the top. So the gold line here is actually the gold price, 52.7% up year to date. In blue, we have the the NASDAQ index up 16%. S&P is up 11%. Bitcoin had a good streak. That streak is gone. It's now down 11% on the year. And energy prices are struggling. So energy companies not doing great. The WTI is down 19% year to date. Putting our macro together, if you had to speculate as to which of these trends will likely continue or reverse, what would you say?
I would say I I think stocks will probably hold up for a while longer. Um, I think the crude oil prices are probably going to be still struggle to go up. I think they're going to continue to maybe be sideways to down. I think the supply demand in crude oil is still kind of weak. I think there's plenty of oil around, and then it's just a matter of if there's periodic supply disruptions or not. Refining margins have gone up, so some oil refiners are doing better. But I think that basically oil is not a good place to be. I'm underweight the energy sector in terms of the stock market. I think I don't have a strong view about Bitcoin. I don't have a good framework for analyzing it. It is clearly a risk appetite measure for the most part. And so I think it's probably had its best move for a while. I think it'll probably take time to consolidate it at best, and before crypto does well again. I think they've kind of had their run for now. So I think stocks are the best bet of those asset classes. I think gold may hold up. I think the demand to move assets or kind of exposure out of the U.S. and the U.S. dollar in particular will probably go on for a while longer, at least as long as Trump is there and causing chaos. I think a lot of central banks and a lot of people outside the U.S. are trying to look for alternatives to the U.S. dollar. There aren't a lot of good alternatives, so that's why gold has benefited. The euro has benefited, and so I think there's going to be some further moves there to come. I think there's going to be people looking for ways to kind of avoid having too much exposure to the dollar and the U.S. Relative to, let's say, the last 10 years, where people wanted to own the dollar and U.S. assets. So I think that's going to be one of the headwinds, but I don't think Bitcoin and other cryptocurrencies can serve that role. So I think it is going to be gold and other major non-U.S. currencies that'll benefit from that.
Maybe we don't have to discuss Bitcoin in detail, but generally speaking, whenever you see an asset that has historically followed another asset class, so for example, Bitcoin has closely followed stocks, and to some degree, it still has. You can see that the correlation remains consistent. It's just that Bitcoin has a much higher beta, and so this downside move in the Nasdaq index from the middle of October to now has really been amplified in Bitcoin's move downward. But anyway, whenever you see any sort of divergence between two asset classes that have historically moved close to each other, what are the questions that you ask yourself to analyze that movement?
Yeah, and in the case of sort of Nasdaq and Bitcoin, I mean, of course, the big difference is that Nasdaq represents companies that have earnings and fundamentals, and there's cash flows and behind them and all that, whereas Bitcoin does not. So there is no PE, there's no kind of fundamental structure for analyzing cryptocurrencies, Bitcoin, and so what the common factor they have, of course, is risk appetite, and basically the PE on, say, the Nasdaq and the movement of something like Bitcoin are going to be the things that are moving in parallel. If investors in general have more risk appetite, they're going to pile into riskier stocks and riskier assets like crypto. And I think what we're seeing now, as you said, since mid-October, there's been a big pullback in kind of risk appetite, but earnings have still been pretty good. And so you've seen Nasdaq has come down, but not nearly as much as crypto has. And the same thing is true even within sort of the tech space or the equity market. The most speculative tech stocks and stocks that have little or no earnings that went up massively from sort of April to October, double or triple in some cases. Those are the ones that have fallen the most. They've really cracked hard, down 30% in some cases or more. Whereas the big major Nasdaq companies that we all know are down, but not nearly as much, and have earnings to kind of support them. And so I think, to me, it's a real kind of almost clear measure of risk appetite and how speculative investors want to be. And so what normally happens is you get a big burst of speculative outperformance, like from April to October. And the same thing happened in late 2020, early 2021, until about February, March of that year. You had a massive rally in all the small caps, all the growth stocks, everything that was risky went up. And then they cracked, but the rest of the market still held on and kept going up for another 6 to 12 months. And only then, when the economy really slowed down, did the rest of the market come down. So I think that's what we're doing right now, is we're seeing the really risky stuff like Bitcoin and the stocks with no earnings crack, but the rest of the market, I think, will hold up because they do have earnings. And then you'll see the next phase, of kind of the rotation go on from here.
So yeah, in the past, you're right. Slowdown in the economy has predated a slowdown in the stock market. But could the reverse happen this time? Or will the reverse happen this time, where we have basically a correction in equities markets or capital markets overall, which will lead to the wealthy who hold these stocks losing a portion of their wealth, and then they spend less, and that leads to a slowdown. That leads to the slowdown in the economy.
Yeah, no, I think that's the risk here, is that we've gotten ourselves now in a situation where asset prices and the wealth effect on the higher end consumer and companies is a much more dramatic impact, or potentially a dramatic impact, than it would have been even just a couple of years ago, because you don't have the kind of broad the broad improvement in the economy and the labor market, and kind of the lower and middle classes spending and doing better, which we had in kind of 22, 3, and 4. And you don't have the kind of broader based investment going on in the economy as well, that you had from some of the Biden policies and things like that. That now the policies movements and the way markets have behaved have kind of shifted toward focusing more on a smaller number of companies and a smaller number of households, and that puts the risk that if something cracks within those households or those companies, that the overall economy is going to feel it a lot more than it would have even a few years ago.
Thanks a lot, Sam. Appreciate your update as always. Where can we learn more about you and Mill Street Research?
So millstreetresearch.com is the website. There's a lot of information there, some sample reports you can check out. And then I do post on Blue Sky a lot more now. You can find Mill Street Research there, where there'll just be comments and updates about what I'm seeing in the market. There's also a blog on the website that you can subscribe to if you want to get updates for that. And of course, institutional investors can reach out if they want to get access to the institutional research product.
We'll put the links down below. Follow Sam there. Appreciate it, Sam. Speak next time.
Thanks very much. Good to see you, David.
Yeah, good to see you as well. Thank you for watching. Don't forget to like and subscribe.